Well, welcome back, everyone. New all-time highs. This market is unstoppable in slow motion. We do have a holiday week of trade this week. We are dealing with Thursday, market closure for the US Thanksgiving, Friday, half-day trading. And typically in a week like this, we end up seeing the market coast into the end of the week and go into the week after with intent to make the bigger move. There's also a very typical wobble or injury, if you will, in a week like this. And tomorrow would be the day where this can potentially happen. Now, over in the active trader room, we identified that the market has moved up again into that uppermost quadrant of that four quadrant channel. And you can see the channel in all of its splendor and glory there. That uppermost quadrant is an area where we're priced to perfection and we've got to perform. Now, over in the active trader room, we identified a couple of ways the market could close and what it would imply for tomorrow's action, where we do get the core PCE price index data, which is the inflation print that the Fed tends to use. And we also get core durable goods data. Now, coming from this afternoon, FOMC meeting minutes, the data earlier today from consumer confidence, the conference board, we did see the market give us a little bit of indecision and range and chop in the morning, and then break free of that and try to continue to push up. We identified that that would be the likelier outcome, and we used our tools to do so. And furthermore, suggested that if we do see a close closer to 601 on the SPY, we're likely to see price action further up in tomorrow's market, but at some point, very likely tied to the 10 a.m. inflation print tomorrow, a move down could start. Now, that move down is unlikely going to get us low enough to break anything, perhaps down towards the 595 area at the low end, and then potentially see a little bounce form to start a small repair as we move into the holiday, quote unquote, long weekend. The technicals can give us a little bit more of a deeper view. You're now looking at an intermarket analysis with daily candles for the Russell, the Dow, the S&P, and the NASDAQ. You'll note that the S&P and the NASDAQ are the only two indices that have not yet come out and pushed out to higher all-time highs versus the highs that were made on November the 11th. The Dow has, and the Russell has. Now, the Russell has closed yesterday at those higher highs today, has given us a little bit of negativity. If we break the time frames down into 4-hour chunks, we get to see what's happening under the hood from a signal standpoint. And if you're watching yesterday's video, the insight that I wanted to impress upon you is that we may be at the end of the champion trend pack sequence of signals. The champion trend pack sequence of signals and the champion trend pack has been developed by Rob Hoffman, the only 33-time real money on-site international domestic trading champion that we know of. And his toolkit over here has a rhythm or a dance. Stage 1, champion trend, champion cross. Stage 2, wealth signal. Stage 3, the breakout forecasters. Once we've had 3 bars or to 5 bars of absence of breakout forecasters, we tend to be done the sequence, and we have risk of pulling back to the last or second last breakout forecaster. Now, this has happened on the Russell. Has it happened on the Dow? Not yet. Has it happened on the S&P? Well, technically, yes. Now, if we've come down and bounced back up and broken above the highs, are we now back in stage 1, starting the sequence again? Well, this can very well be the case. We do need to see follow-on signals in tomorrow's market to validate that. And as of right now, if we take the signaling index, which has a lot of the NASDAQ key listed stocks within it, the S&P, and break it down into multiple time frames and add a couple of other tools. I've added the Triple S indicator, and I've added some WealthChart member exclusive tools like the Spike 2.0 tool. And what you can see on the very left-hand side of the screen, the daily chart is in an incrementally bullish signal state. The 4-hour chart as well is in an incrementally bullish state, and the 1-hour is as well. The 1-hour is the most advanced in its sequence of signals, and it's still not yet telling us that we're done stage 3. So what effectively we've got is a higher probability for a rise, define a high, which probably would be at or above the all-time highs made for the S&P minis back over here on November the 11th in the 60, 50, low 50s. Getting up to that high or slightly higher is the likelier outcome before exhaustion sets in. We have got very little room left on that 1-hour chart, and we've got about a day to maybe a day and a half of room left of upside on that 4-hour chart. This leads me all back to a market that has some risk associated with a rise, but a higher high before a pullback as a likelier outcome. I hope that this has been an informational video for you and helpful into this holiday long weekend. Have an incredible rest of your day, and thank you for watching.